9-month revenue and PATMI coming in at 74% and 76% of our full year forecasts. In terms of its performance in the third quarter, total revenue, it grew by about 10% year on year. And this was mainly because of higher subscription sales. So, in order, just to brief about the company, Adobe, it's basically a software company, and it has two business segments, digital media and digital experience. So digital media, it's further classified into two segments, which are Creative Cloud and Document Cloud. So Creative Cloud, it basically provides solutions like to edit to edit a photograph or video, and also the graphic designing tools. So that the flagship products under this segment are it's Photoshop software, Premiere Pro, as well as InDesign. In terms of its second segment, which is Document Cloud, the abilities. And moving on to the second segment, which is digital experience, it basically provides solutions for marketing and analytics to the companies. So jumping on to the positives, the Creative Cloud segment revenue, it grew by about 11% year on year. And this was mainly because of a surge in digital content creation as well as consumption. For instance, if a particular company currently it has digital transformation plans are ongoing. So if a particular company it wants to have a digital presence, then it has to prepare social media posts or design its website. So the Adobe's products will help the companies to have a digital presence. So the company Adobe, it has integrated the generative AI tool Firefly into most of its products, and the company so the tool, it basically helps companies, the users to like generate images from the simple text prompts, as well as to add or remove any particular objects from a portrait photograph. So these are the key features of the generative AI tool. So moving on to the second positive, Document Cloud revenue, it was the fastest growing segment with about 13% growth year on year. And this was mainly because of the shift to electronic work processes, as there was a significant growth in PDF over a billion users. They spiked by about 70% year on year. So moving on to the negative, Adobe, it generates about 40% of its revenue from international markets. And as a result, due to the strengthening of dollar against the foreign currencies like euro, Japanese yen, it witnessed a foreign exchange headwind of about $125 million in the third quarter. And despite the foreign exchange headwinds, the software companies, they are witnessing a strong demand, mainly because the revenues that are generated by software companies, they are mainly recurring in nature. So like the companies, they don't have to incur additional cost to deliver that particular product. And as the companies, they have already contracted in advance for 2 or 3 years, they are recurring in nature. And this is the reason that Adobe, it has generated about significantly high gross margin of about 88%. So moving on to the outlook for the next quarter, in the fourth quarter, it expects a revenue growth of about 10%, and this would be driven by its digital media segment. Meanwhile, in terms of its bottom line, earnings per share is expected to grow by about 23% in the next quarter, and this is mainly because of top line growth as well as higher operating leverage. So, in terms of its generative AI tool, the company, it recently announced that it would start monetizing its Firefly tool, and it's now commercially available to enterprises. So the pricing, like planning to monetize it via a consumption usage based policy. Like it would initially provide 25 free credits to the users and to use those particular tools. And once they have exhausted those particular tools credits, then the users, they need to buy, they need to pay more to use the particular services. So starting plan, it would be like about the companies, they the users, they have to spend about $5 to get 100 credits per month. So management, it highlighted that in the near term, they don't expect any significant growth from AI-driven tailwinds, mainly because they are still in the initial stage, and it would take a time to convert those free users into the paid subscribers. So as the company, it has been continuously innovating the product and introducing new feature. It plans to hike prices for its Creative Cloud flagship products like Photoshop and Premiere Pro by about 10% beginning in November. But these price hikes, it should hit the customer base only at the end of 2 or 3 years. So it should not provide a significant tailwind to its top line in the near term. So moving on to the valuations, we maintain a reduced recommendation with a slightly higher target price of $441. And this is the surge, the hike in the increase in target price. It was mainly because we have increased our revenue and PATMI estimates for next year by about 1% and 2%, mainly to reflect the price hikes and the minimal benefit from the AI-driven tailwinds. And overall for Adobe, we have a reduced recommendation mainly because of its valuations. We believe that over the last 4 months, the stock price, it has surged by about nearly 40%, which is equal to like a 70 or 75 billion market capitalization growth. So we believe that this is significant because even if we assume that the Creative Cloud segment revenue would double with its Firefly, no, Firefly contribution because of Firefly, it would be an annual incremental profit opportunity of only about 3 to 4 billion US dollars. So next slide, please. So let's compare Adobe's results with the other major software companies like Microsoft, Oracle, and Salesforce. And just as a disclaimer, we don't cover Oracle and Zoom. So overall, the results were in line with the major companies, and the revenue growth was about 10%. And the Microsoft, it reported a revenue growth of about 8% year on year. And this was mainly because of continued demand for its Office 365 offerings from its enterprise users, as well as Cloud Azure as the companies, they digitize their operations. And Microsoft also has integrated AI into its Office 365 platform software. It would generate the first draft of the presentations, or it would summarize a particular paragraph in Word. Meanwhile, Oracle, it reported a 9% revenue growth, and this was mainly because of continued demand for its database management softwares. So it basically provides ERP solutions. Like the companies, it can use that particular solutions for its financials or inventory management or project management tools. So meanwhile, Salesforce had reported the highest revenue growth of about 11%. And this was mainly because of continued demand for its core products like Sales Cloud and Service Cloud, which basically helps to automate and manage sales tasks and provide a personalized customer service to the users. And in terms of its, meanwhile, the PATMI for Salesforce, it came in significantly higher, mainly because the software companies, they are witnessing the macro pressures like the slowdown in enterprise spending. So as a result, they have been focusing on reducing their costs. And Salesforce, it has been significantly focused on reducing their costs over the last 1 year or so, and mainly through job layoffs and real estate consolidation, and reducing the travel and marketing expenditures that they incur. In terms of guidance for the next quarter, we can see that the revenue growth for most of the companies is similar to the second quarter. And this suggests that although most of the companies, they have integrated AI into their products and they have started to commercialize them, but most of the companies, they don't expect any significant contribution from AI at least in the near term, in the next quarter or two. So lastly, for Zoom video communications, it has been continuously witnessing revenue drop, mainly because mainly because the demand for its video conferencing services it has dropped, mainly as the employees they have started returning to office, and students they have returning back to the colleges. So the pent up demand for its product, which was witnessed during the pandemic, it has been falling down. So that's all for software. I would now like to pass on to Sean for FOMC.
Yep. Thank you, Ambrish. So I'll be going through the meeting highlights that happened on the 20th of September last Wednesday, in case if some of you guys have missed it. Yeah. So last week, the Federal Reserve have decided to maintain the federal fund rate at a range of 5.2% to 5.5%, as they have stated that they did observe some signs of moderation on inflation, and they see that the current stance of the monetary policy as restrictive. This decision was also in line with market expectations. So in terms of the guidance that was given during this meeting, there was hawkish sentiments being shared, as a majority of the participants believe that it is more likely than not that it will be appropriate to raise rates one more time in the two remaining meetings this year. So it signals to us that we could expect another 25 basis point hike by the end of this year. So if you shift your attention to the left of the screen, you're able to see this depicted in a dot plot graph that was provided in this meeting as well, as 12 of the 19 committee members assessed that the central bank benchmark rate will be peaking in a range of 5.5 to 5.75%, while only 5 members indicating the rate to remain unchanged for the rest of the year. However, in terms of the rate cuts expectation for the subsequent years, the optimism was toned down a little, as the projected federal fund rate at the end of 2024 and 2025 was revised up by 50 basis points as compared to the previous SEP that was released back in June this year. So from 4.6% previously to 5.1% for the year of 2024, and 3.4% to 3.9% in 2025. And although recent inflationary data points such as the PCE and the CPI index that the Federal Reserve watches closely have shown signs of moderation since June last year, back when total and core PCE was rising approximately 7 and 5% year on year. The latest results for the total and core PCE was released in July, rose by 3.3 and 4.2% year on year, while August total and core CPI rose by 3.7 and 4.3% year on year respectively. So I mean, these have shown signs of inflationary pressure still remaining sticky and also well above the Fed targeted rate of 2%. So I mean, to conclude, it appears that we could buckle up for one more potential hike while we approach the end of this year, as we are still a quarter percentage point away from the expected benchmark rate for this year, and also be prepared for rates to stay higher for longer. And do note that the possibility of further rate increases has not been taken off the table yet, as it was mentioned on several occasions that inflation, if were to trend higher, then the committee members are prepared to raise rates even further if appropriate. Sorry. That's all I have for the meeting, and with that, I'll like to hand over the time to Zain to share on the technicals. Thank you.
Thanks, Sean. I'll now move on to the technicals. So first up for S&P 500, last week the development was that we actually, after a long period of consolidation, we actually saw a breakdown of this consolidation wedge as shown in the chart. So that signals some downside. And last week we actually retested the horizontal neckline support, which is around the 4,320 level, which we are actually close at on Friday. So I think this level will be critical. If we see some support coming, we might see a bit of a bounce. But if we don't, then that could signal for some further downside. Try and retest the main uptrend channel support, which could bring us down to closer to about 4,230 over there. Yep. So for this week, resistance, the near-term resistance could be around 4,400 to about 4,440 area, while the support could be at 4,230 to about 4,330. Yeah. Next slide. Sean, can you move to the next slide? Yeah, thanks. Okay, so for individual counters, it will be Yang Zhejiang Shipbuilding. So for this, technical sell at 165, take profit at 155 and 150, stop loss at 170, and the stop loss goes at 172. So for this, the trade was actually invalidated since it hit our stop loss. So in terms of the trade idea wise, there was a potential breakdown of a consolidation triangle after the stock actually hit the main uptrend channel and kind of consolidated over there. Given the weakness in terms of MACD as well as RSI. So with that, potential support would be at 155 as well as 150 if it were to retest the previous resistance breakouts as well as the uptrend support line chart. Yeah, so that's all from me now. I'll hand over time to Paul to talk about his Valuetronics initiation. Thanks.
Thanks, Zin. So we initiated coverage on Valuetronics, turning around after 5 years. So what we're trying to say is that since 2018, the revenue has been declining and we see it starting to turn around. Next slide. So in terms of the background, so they've been around since 1992. So it's kind of old company and they've been listed since 2007. They are basically a contract manufacturer, something like a venture. But in terms of the breakdown of the revenue, 80% of it comes from industrial and commercial. So think of it of such products as low volume but high mix kind of products and mini industrial and for industrial purposes. Now, unlike your consumer electronics, which is smaller for them at 20%. So in terms of the services that they do is like any typical contract manufacturer or EMS or electronic manufacturing service provider. They do PCBA, basically is your PCB board that you see, you open up any computer, there's the green board, and then they will assemble all the components on it. There's a full box build. So what it means is that they will completely assemble the product and then ship it out to customers. So there's more value add because it's an assembly work or module assembly. So some of the big parts where you can't assemble everything because it's of the logistic cost, you will assemble parts of it and then you will send it to another customer's factory that they will assemble into the full product. In terms of the manufacturing of, like all contract manufacturers, the way to have a higher margins is to manufacture the plastic and metal components. They have two plants, one in China and a new plant in Vietnam. So in terms of the investment rationale, so they faced headwinds the past 5 years, revenue down 30%. It all started in 2018 when Donald Trump imposed the import tariffs from goods shipped from China into the US. Tariffs for their customers are as high as 25%. So obviously, customers have to shift out of China. So that hit them quite badly. The customers shifted out into Indonesia and some into Mexico, especially the auto customers. After that phase was over, they faced challenges in pandemic-related component shortages, I think, and that hit their margins because the spot prices for components can shoot up maybe as much as 5 times during 2021, 22 to a certain extent. They didn't benefit like what other consumer product manufacturers because of the ramp, because they were mainly into industrial products. And then when travel is disrupted, it does affect their ability to secure new customers because customers can't go into visit their plants in China or even their new plant in Vietnam. But we think things are turning around. So with the new plant in Vietnam starting operations in 2022, customers are shifting out of China. Now they have a new plant. They're shifting out of China not just because of the high tariffs. They're also shifting out because customers want to de-risk due to escalating geopolitical tensions, obviously between the US and China. They also officially announced that they have 4 new customers. A lot of it are industrial use. Most of it is electronic price tags in retail shops, liquid cooling systems for computers, electronic surveillance in theme parks, and network access products. So these are not high volume, but they're high mix and higher margins. So their margins of 13% is almost double the industry margins of 8%. In terms of the other reason why we like it is also the attractive valuations. For the upcoming 1 year forward, we think they're trading at 1x EV EBITDA. So basically 1x cash flow. And they're paying a dividend yield of 5%. They have a net cash of almost 180 million almost, which is 80% of the market cap. They also have a share buyback plan. So last year, February, they announced almost 45 million Sing dollar buyback plan. So they still have another 60 million worth of shares to buy if you use the current share price. So we initiate target of 61 cents with a target price of 11 times. Next slide. In terms of some of the products, the one on the left, these are LED lights mainly for Philips. I think it's quite obvious. The rest of the products for industrial is a bit more nuanced. Most people won't understand it. But like this product at the bottom, network dispenser, these are installed in farms, and they will electronically kind of dispense chemicals and so forth in the factory in the US agriculture sector. Then they got cold chain, then they got shavers, also for Philips and thermal printer and transaction printer. All these are for industrial use, so it's not for consumer electronics. Next slide. So this is my last slide for the company. So in terms of valuations, we use the 11 times or close to the industry 10.8 times. The other thing is that on the EV EBITDA, once you take into account the net cash they have, they are trading historically at almost 1.7 or 2 times cash flow. And compared to the industry, about 7 times. Once you take into account the balance sheet, but of course, no PE ratios don't take into account the balance sheet. Okay, next slide. I'll run through our usual weekly. So in terms of the macro news last week, a lot of it was a lot on the electronic sector. So for Singapore, sorry, on the export sector. So for Singapore, exports were contracting still pretty sharply, about 20%. Electronics contracting even more, about 21%. So after 11 months of we are in the 11th month of contraction. So the base effect should see some stability, because after 12 months of contraction, then when you do the year-on-year base effect, they should see some stability. So we will also see some stability a bit right now. We can see that Korean exports are also although they're still contracting, but they're starting to stabilize from mid-teens in July to high single digits. But that's mainly because of the base effect, because after 12 months of slowing down. The likewise for Taiwan exports. So the whole export sector is still weak up to August. Then in terms of the US imports, when you look at the volume shipments, container shipments is also down about 15%. That's on last two macro points. I think in terms of the US, you do see some monetary data and continues to be weak. So loans are contracting. So it's the second month of contraction. We'll show you a chart later. And credit cards is actually growing, which is not a positive sign for the consumer. They're growing almost at a record, like 100 billion per year in terms of record, almost like 1 trillion of credit card loans. So this is a bit of we see this as a bit of weakness because this is the highest cost of credit, and it probably reflects a bit on the balance sheet of the US consumer. Next slide. So in terms of our tactical views, obviously, like Sean mentioned, we have the Fed rate decision is unchanged at 5.25. But for us, there were also two key messages for us. They are for in the recent meeting. So the Fed is still prepared to raise rates one more time. So there are 2 more rate decisions, November and December. But we think it's unlikely, because what we do see is that the PCE or inflation is trending down. Like we highlighted last week, the shelter inflation is trending down towards as well, weakest in 2 years or so. And also all the market indicators for rental inflation or shelter inflation is sliding downwards almost a year ago, and there's always a lag. So we continue to think that PCE will continue to trend down, and that shouldn't cause the Fed to raise rates in the next 2 months. The other thing is that based on their projections, the other message is that interest rates will be maintained at a higher level than anticipated. So why we say that is that in their forecast for 2024, they were initially expecting interest rates to be at 4.6%, but they raised it 50 basis points to 5.1. They are raising it because they expect labor and economic conditions to be stronger than expected, and it's harder to bring down inflation, of course. And another result of this is maybe the US dollar should be stronger if you're going to expect interest rates to be higher for longer. In terms of REITs, we always get this question. So in terms of our macro view for REITs is that we are still favor REITs. For us, it's more of a relative rather than absolute return performance, because we think they can outperform on a relative sense, because when economies are decelerating and also when interest rates have peaked. because at most we're going to get one more last rate hike. And also the other thing, of course, we do worry is that in this current environment, the REIT model, business model does not work in a negative carry environment. So what it means is that negative carry means your rental income. No, let's say you buy a new house, no, your rental yield is maybe 3%, but interest rates are 4 to 5%. So what it means that the REITs cannot acquire anything. So without that, there's no acquisition growth, and the model is in a way broken. But what it means is also that it will take time for rents to climb in order for them to allow this positive carry to make acquisitions and grow. Otherwise, right now they just have to rely on organic growth. In terms of the weeks, the events, okay, the main one will be there'll be a Powell will be having some interview with some teachers event. And then on the 29th, you have the important core PCE or the inflation indicator that the Fed likes to use when they say their 2% target. But again, I think expectations are continue for core PCE to trend downwards. We have a few webinars. We have one webinar this week at 28, and then next week we have a few, including Centurion, Marathon Digital, US company, and also SingPost. So I think SingPost is probably the first time they're doing it. Then we have a strategy and stock picks for Singapore, and then strategy and stock picks, our quarterly strategy for US market on the 12th. Next slide. In terms of, this is just some illustrations. On the left is the Korean and Taiwan exports. You can see that they continue to slide, but you might see some bottoming out now. But I think that that's pretty obvious that they will bottom out because can't keep on contracting. But the thing is the recovery. So for us, we think the rebound won't be strong. We think the rebound will be like what is happening in 2014, maybe 3 to 4% kind of export growth, because global growth, it continues to be weak. Likewise, we see a similar trend in exports coming down in Singapore. So NODX is the total exports, non-domestic, non-oil exports, and then there's electronic exports. Next slide. Then of course we just have a quick look at what's happening in the US monetary. So you can see that on the left is the loans growth in the US. So I guess the worrying thing is that you see a sharp deceleration in loans during recessionary years, like what we saw in the 2008, 2009 period. On the right is the US consumer continues to ramp up credit card debt, maybe because they don't have to pay down the student debt, but US credit cards is almost 1 trillion. So it does show a bit of, it does show for us at least fragility for the US consumer balance sheet, because nobody borrows from credit card unless you have to because of the higher cost, but continues to grow. You can see that before the pandemic, it was 800 billion. Then because of all the stimulus, the US consumer balance sheet was very strong. They were flush with savings. But after you tapping on that, you can start to see that credit card continues to climb up. Next slide. For my last slide, the one on the left, the blue line is the US Treasury yield, 10-year yield. Right now, the yield is almost back to 207 levels, new record levels. So what it also means is that our 40-year bull market in bonds is in jeopardy. And one of the reasons is also on the right is the amount of US government bonds issued. So this is the ones that are held by public, not held by the Treasury, because the US Federal Reserve also does buy their own, but this is held by public. That means anything not, so long as it's not a government agency holding it. So what you can see is that since the crisis, there's been a lot of new debt being issued. This year is running at almost 2 trillion of new debt. So of course, the market is facing a hard time absorbing all the new debt. One of the reasons is a bit of a technical issues, because in California, they deferred tax collection from April, or at least tax declaration from April to October. So there's about almost 500 billion of tax they should have collected, which will take time, but it should be collecting from October. So we think this could be one of the reasons too, that apart from the FOMC or Federal Reserve not raising rates, is that the tax collection will improve, and it also means they won't need to issue so much debt. So we think yields should start to at least taper down from the fourth quarter onwards. Okay, I think that's it. We can move on to Q&A.
Hi, I will answer some questions. What are your views on GokuLand FA and TA? Yeah, so for TA, I'll leave it to Zain. But for the FA portion, GokuLand, of course, they're hit by they're continuously hit by the cooling measures. The biggest one being the one affecting the overseas uh uh residents, 60%. I mean the overseas foreign buyers. Yeah, so a lot of their GokuLand, their assets are in the higher end. So yeah, they're hit by that. But one thing we like about GokuLand is that they are shifting their business, a lot of it to their investment business side, which is Goku Midtown. So Goku Midtown, they'll start to contribute significantly to their revenue numbers in the coming few quarters as Goku Midtown it TOP only in January, so it's slowly starting to contribute revenue. Yeah, so that is one of the good things when the fact that we like GokuLand is because they are expanding rather expanding away from just the property development side into more of the investment side as well. So now the split's about 50-50. Yeah, but we will not cover them. Yeah, so I'll leave it the T portion to Zain. The next one is my take on FA. My take on S-REITs. Is it time to invest? Yeah, so for S-REITs, of course, we all know they're hit by the last week's Fed chairman Jay Powell's his comments that rates will likely be high for longer. So that will have a mid-term, maybe in the next 2-3 years, REITs will still face some challenges as interest rates remain higher, and when REITs start to refinance their loans at these high interest rates, everything, the cost will spike up. So it's still challenging. Like Paul mentioned earlier in his strategic piece, we are relatively overweight on S-REITs as compared to the other sectors. But we do know that it's hard for these S-REITs to grow their dividend DPU because of the high interest rates. It will eat into their NPI, the net property income level after that net property income level. So the distributions as a result will likely either remain flat or slightly decrease. And I mean, unless you're a hospitality REIT or something that can really boost, or your top line can really jump. Other than that, it's hard to maintain your DPU. Yeah, but as a relative, but we are relatively overweight on S-REITs because we are in the yield play. We are having a yield play right now as our strategy. Yeah, but is it time to invest? S-REITs now, their price to NAV has actually fallen slightly under slightly under COVID lows. So COVID it was about 0.9. Now it's slightly under that. Yeah, so if you are a very long-term investor, I feel it's a good time to invest as well. Like as we saw during COVID, the REITs also rebounded after its lows. Yeah, so usually if you're a fundamentalist, you believe that the share price will follow valuations in the long term. Yeah, so if you believe that, then we also think it's a good time to invest in REITs. Yeah. Can I give you a comment on Maple Pen and Cromwell? Yeah, we do not cover both stocks, but I'll start with Cromwell. So for Cromwell, their share price has really fallen quite a bit. And I don't see any particularly bad news or anything that's wrong with them fundamentally. So they're paying about 12% dividend yield now. Yeah, so for Cromwell, I guess that the office market for them is not doing too good, but their logistics side of things are doing very well. Yeah, so for that, yeah, based on the dividend yield, I think it might be okay to just invest in them for long term at 12%. For Membership Pen Asia, similar, they have a good sponsor, and the biggest asset is VivoCity. That's also doing quite well. Yeah, but they have some overseas properties that are lagging behind. So yeah, that's more of a mixed bag for Membership Pen Asia. I mean, that's my view, but yeah, sorry, we do not cover these two stocks. So we do not have a target price or any recommendation. most of our REIT share price have fallen. Can you share what are your top 5 REITs worth investing for dividend yield play? Yeah, so yeah, like I mentioned, the REITs, a lot of it are trading at good valuations. So which is also why we like some of them. And if you are talking just about dividends, a lot of the overseas REITs, they are trading at very high dividends, especially the US office. They're trading at upwards of 30% over. For me, I have a buy recommendation on Prime because of its high dividend yield. Even though the share price has fallen so much, it's trading at a less than 0.2 times price to book, but its dividend yield is over 40%, 30-40% at this price. And I've also taken into account the fact that the US market is not doing too good. So I've already, even after factoring in for the weaker US market, low occupancy and such, I still forecast that the dividends will be about 30 or 40% at this level. So for me, I think it's worth investing for a dividend play. So that's for Prime. And then for the local counters, yep, we have coverage for some of the REITs. You can take a look at during in our morning note. We have our REITs coverage there. I mean our in-house coverage, and then you can take a look at the recommendations there. But if you ask me to pick just one top REIT for dividend play, I would say Prime US because of the high dividend yield. Yeah, I hope that answers the question. Yeah, there's some
Maybe-
question. Yeah.
Okay, no, don't worry, you go ahead.
Yeah, any latest update on Prime US REIT? Yeah, so there are no updates for Prime, and the outlook for me is same as I mentioned earlier. You still have a buy call. And one REIT to look at with good gains, which is that one. So in this current market, we do not expect REITs to have good capital appreciation potential upside because of still the high interest rates, which Paul mentioned earlier. The whole fundamental investment business model of REITs is have to have that positive carry, but then with higher interest rates, it's hard to have that positive carry. So yeah, we do not really expect the share prices to be able to really spike up, but it's more of a dividend play for now. So, but if you ask me, which one has potential for more gains? I would say Prime as well, but you have to note that it'll be weak for as the US market has a lot of negative news around it. Yeah, so the share price likely will remain weak in the near term, but in the longer term, we believe that the share price will move back towards its closer towards its NAV. Yeah, which is about 75 cents. Now it's trading at in the teens. Yeah, I think that's all for me. Maybe hand over to Peggy. You want to mention?
Thank you, Darren. Okay. Let me take this question. With the oil price rising, any impact to airline and the tourist industry, hospitality, such as C6L, S58, J85, and HMN? Okay, these are the 4 stocks mentioned here: SIA, SETS, CDL, Hospitality, and Escort. So maybe I answer the airlines questions first. Yes, jet fuel prices have been rising. It's gone up by about 6% over the last 1 week, but it's still about 2%, 2.4% lower year on year. Okay, this level of oil jet fuel price is actually what is in my forecast. So for Singapore Airlines, at this time I see no changes to my target price of $6.80. The airline stocks has been beaten down by actually not just the higher rising jet fuel prices. Okay, first thing first, the jet fuel price has been lifted mainly because the Russian has banned their diesel export So diesel is gasoline. Jet gasoline is tied to diesel, very, very closely tied to diesel. So when diesel price move up in the market, jet fuel price also rise in tandem. So we not sure how long this ban will be held. But if Russian were to let the ban remove the ban, then there's room for jet fuel price to come down. The one other reason why I said so is because the airline industry has been hit recently more by the engine issue. Pratt & Whitney found that they had some manufacturing flaw in their about 1,200 of their GTF engine has been pulled, has to be pulled from service. That affects the Airbus 320 new jets, which Scoot also had issued a warning to say that they might be affected. So these engines might have to be put for inspections between about 1,200 engines between 2023 to 2026. So and the US not helping is the fact that the US Federal Aviation Administration has actually put it down that they want the airlines to conduct immediate inspections. So it sounds quite serious. The flaw seems to have could have an impact on the safety of the aircraft. Then following shortly after, I think last week, 2 days ago, this General Electric and Safran, their joint venture in CFM International, which is also an engine producer, announced that they found some fake engines floating around in the market that has been disputed by AOG Technics. So these CFM 56 engines are deployed on many flights, including some cargo planes as well. So they are now as to how they're going to resolve this, I'm not too sure. They have not been announced, but suffice to say there'll be more step up of engine checks on engine and checks and engine replacement and MRO work. So potentially helping the MROs like SIA Engineering and ST Engineering, but bad for the airlines especially now that they have been very eager to put back their capacity after COVID. This engine news could set them back by a few quarters. So that this we think is the reason for the weakness in the airline prices. It's not just Singapore Airlines, but also other listed airlines in the other markets. Similarly, for that reason, also SATS would also be impacted if the airlines have to ground their planes for checks. So I leave the hospitality part to Darren to address. Thank you very much. I'll pass it on to the rest of my team.
Yeah, I'll take a question. So there's one question in the chat box asking for the outlook for micro results that is releasing this week. So so overall for memory, including Micron, the outlook is not that good because I published a report a couple of weeks ago, summarizing all of the outlooks for the third quarter as well and the full year. So all three companies, which are Micron, Samsung, and SK Hynix, they're all saying that the demand for this is going to be negative, and it's going to be continued weakness for your smartphone, PC, as well as your traditional servers. And the only strength will come only from the AI market. But the AI market only makes up a small portion of the overall market, so that the strength there is unable to offset the overall decline. So yeah, overall, we still think that it's going to be a weak earnings that is releasing this week. But again, I guess the only bright side would be the continued strength in AI, and then as well as that the fact that the prices for memory, the decline for the prices of memory is starting to slow down as well, mainly because of the inventory supply demand imbalance is going to normalize further. Yeah, I hope that answers your question.
Yeah, perhaps I'll take the question if US Fed were to raise rates by the end of this year, does this mean that SG fund deposit rates, T-bills and CPF rates should stay higher for longer as well? So I mean, the answer to this question is yes. Rates for FD and T-bills will continue to stay slightly elevated until at least the end of this year. But however, I mean, if rates starts to taper down in the following year, then I mean, we should also start to see the yields for these instruments to come down as well. So I mean, currently for our 6 months T-bill auction, the cutoff yield was at I think 3.73%, I believe. And I think we should see the cutoff yield for this coming 6 months T-bill yield auction on this coming Thursday to hover around the same level or slightly higher. Yeah. However, I mean, if you expect T-bills rates to go to like, let's say 4% or even higher than 4%, like previously back in, I think, December last year, it is unlikely. However, I mean, if let's say the Fed were to say they were to raise interest rates even higher, then that could be a possibility. However, as of now, it is unlikely, but rates will tend to stay higher for longer, at least for the end of this year. Yeah, so that answers your question. Thank you.
Ambrish,
Yeah, sure. So there was one question with respect to Adobe. Why your target on Adobe is lowered while many other analysts seem to have feel Adobe has catalysts for growth. So basically for Adobe, our recommendation of reduce, it's mainly because of its valuations. Like it over the last 4 months or so, the stock price have grown by about 40%, which is equal to about $75 billion. And if we assume that the Creative Cloud revenue segment, it doubles because of Firefly generative AI tool, even then it's an incremental opportunity of about $3 to $4 billion. So it's purely based on valuations. And other key point that I believe that the difference could be our target price. It's mainly based on we have considered 1 year profitability. We have considered for DCF, we have considered the profitability for 1 year, while other analysts might be looking at a 5-year or 10-year growth rates. So that's all for Adobe. And there was one more question with respect to Zoom. So will Zoom continue to decline in growth, or is there hope as an AI sector play? So for Zoom, the demand has been continuously declining, and for the third quarter, it expects a revenue growth of about just 2%. It has been moderating continuously, and the company just recently this month it has announced its AI tool, which is AI companion. So it's like at the moment free of cost to the paid users, wherein if a particular user if it had missed to view any particular meeting, then the AI tool, it would just give highlights of the meetings, and the user can just get the direct review of that particular meeting. So in order to monitor how the Zoom can be able to monetize that, we have to wait, mainly because right now it's still in the initial stages, and they are yet to have it a better monetization plans. So that's all for me. Thank you.
yeah, and I guess for I mean, for own view, nobody asked anyway. But for Zoom, I think they for me is also they better improve on their product, because Microsoft will just continue to bite on their tail or chase after them with Microsoft Teams. Because Microsoft Teams is already like free, it's so ubiquitous. Everyone has a Teams. So my own view is that Zoom has to really improve on the type of products that they're having. Otherwise, people might just use Teams, or since it's already incorporated in Microsoft. The other thing on Cromwell is there was a question on Cromwell. So the one thing unique for Cromwell is that, unlike the other REITs, that they probably have better organic growth, because most of their rents are indexed to the CPI. So, what you want, I guess, when you're choosing a REIT, I guess for the very near term is who can reprice the rents fastest. Of course, hospitality can, because the room rates are so strong. The other one could be companies like Cromwell, because they can their CPI or their rents are indexed to the official inflation rate, with a certain cap. But I guess you get that comfort compared to the way other rental agreements are structured. I mean, you want more details, you can ask. Darren. Okay, let me try to answer some. Paul and team, what would you think is the local semiconductors will show a turnaround to uptrend? Is fourth quarter likely to be the year-end festive consumer? I think you could probably see some pop up. Some like what Max also mentioned, there could be some inventory replenishment. Just to understand the process, when there's too much inventory, you get a double whammy. That means your customer don't order at all. Not to mention demand. So you might actually, your orders might just freeze for a couple of months because you got too much. But once inventory recover, you get a bounce. Even though demand may not be that strong, but you can get that bounce. So I think the coming quarter, you might get the inventory replenishment kind of news. And also because the base effect, because last year, after 12 months of decline, the pace of weakness, but we don't think any meaningful recovery will happen until second half of next year. Yeah. I think the only parts that's really strong demand is only AI. After that, I think everything will be like low single digit kind of a rebound. I mean, our own view. Paul, your view on CSC Global and CIFMAC. I haven't followed. I think CSC Global, I think Peggy did mention, so probably can elaborate. But for CIFMAC, sorry, I still don't really follow. So sorry, I don't really. But I think CIFMAC is of course benefiting from the defense spending that's happening in Australia, since I guess Australia now has found a new geopolitical, I guess, country to kind of spend more defense on. But I think Peggy probably give you a better answer for CSC Global. Paul, based on last week's PropNext sharing, any view on this counter? Yeah, okay. I think from the webinar, because there wasn't much news for the webinar that was just held last week. I think the only takeaway for me was that they mentioned that they've been doing well in new launches, and you will only see the recovery in the second half. I think for me that was the only thing new. The rest was pretty within expectations. And I guess the difference for PropNext, if you're asking compared to developer, of course, PropNext relies more on volumes, number one, and number two, they have a 40+% market share. And in the call also, they mentioned they're going to they hope to target like a 60% market share. And number three, PropNext they don't have to worry of a 60% stamp duty for foreigners, which they mentioned, which will of course impact luxury developers like City Development. So they did mention for that, for foreign buying, they do see there are 5 countries that don't have to pay stamp duty, and they do see a lot more foreign demand from US buyers. So probably maybe these are Chinese citizens with US passport that might be buying. The other country is Switzerland, I think Liechtenstein, and I'm not sure who the other two, but there are 5 countries that don't have to pay stamp duty. So that's the difference of PropNext with the dividend yield. They are more reliant on volume than selling price, and of course, they're not impacted by stamp duties like City Development. Of course, they're not relying so much on luxury homes, I guess. Paul, any view that all price likely to shoot above $100 with winter? I don't think. My own view, take it with a pinch of salt, obviously. We don't think it can cross, mainly because what is happening is that's the number one supply cut by OPEC. Of course, everybody knows that. But if you look at the fragile 5, like Iran, Venezuela, I don't have Venezuela all those numbers, but at least I do look at Iran So Iran production is up almost 500,000. US production is also up about 400,000. So I think this is more like OPEC cutting. So I'm not sure how long can sustain. And we're quite bearish on US economy. So that's why we don't think it can sustain above. But there is production. This is mainly OPEC that's controlling the supply. But Fragile 5 could production apparently could go up to 1 million barrels a day. And if you continue to keep such a high price, then the US could also stimulate production. So there is production growth from these few countries. It's not like there's no production. So I'm not sure whether they can actually cross the $100. I mean, that's my own view. And I don't think, and of course, Saudi has always mentioned that they're not very comfortable if oil price go up too high too, because it will stimulate more competitors, of course, from shale. But I guess this is my own guess, probably like 90% wrong. Yeah. Hi, any key takeaways from Ismail webinar? Not much. These are the two. Like we mentioned that he showed some slides, I think, from the results that they've been chalking up a lot of new launches, and this should be reflected in the second half. The number two is, like we mentioned, the foreign demand. And number three, they will continue to keep on paying high dividends. So that's what the three takeaways. I didn't do a slide because there wasn't really much new for me, at least. Okay. When do you foresee the electronics industry? For us, the more meaningful rebound will be second half. But I think, like you saw the export numbers, it's just that it's not declining so much. So I think the market might maybe just rejoice and see that this is a sharp rebound. Yeah. So there could be some short-term rally, but the real meaningful one, I think, is more on the second half. Okay, there are a few more read questions. Can you comment which is better, Aztec or Valuetronics? Okay, so for us, why we prefer Valuetronics is mainly because it's a much there's a bit more visibility, because they mentioned number one, there's 4 new customers. So at least we are not so worried because you got at least 4 new customers. So even though the macro might not be very strong, the macro environment, but at least you have 4 new customers. The valuations are cheap. And then number 3, not only do you get a 5% dividend yield, in the background, the company has about 60 million worth of shares to buy. And this company, the volume isn't like that fantastic. So you at least know there's someone waiting there to keep on continue to buy, at least at the 52 cents. So for me, it's mainly the downside is protected to a certain extent, because the customer is buying at 66. They have a 60 million worth of shares to order at 52 cents. So at least I know my downside is protected. The upside will depend on the new customer. So that's our rationale why we prefer this compared to Aztec. And there's another question, why not UMS? So it's more the risk reward. The valuation is cheap, and there's a buyback protecting the share price and the dividend yield. So it's just at least I got my downside covered. Upside I really depend on macro environment and the new customers ramping. So in view of the Propnex last week and overview, do you see being stagnant or room for growth? I think it will be a bit more stagnant. Because there won't be any news from this company. I think people might just watch how the new launches are performing. If the new launch are stable, and you just have to look at macro data. So I don't think it will be a very strong rally in my own view until the results come out. And they still pay the 6% dividend. So I don't think this stock will, unless you see some very strong property volume indicators coming up, which we will try to update everyone. So for the third quarter, if I'm not mistaken, last week when we talked about it, at least volumes were up almost 40% for July and August, if I'm not mistaken. So that is going to be a positive for them. So that the volumes for new launch sales is coming back now. So we just have to monitor how the volumes are trending. That will affect them. Okay, Berkshire, I'm not sure what's going on. How will the US government shutdown impact the US markets? I don't think it will. It is not about how it will affect. It's how, unless it is how long the shutdown will be. So this thing, I think the market already desensitized. I already had shutdown since 2011. So I don't think there'll be an impact unless this shutdown is, I think the last time was 20 plus days. If I'm just guessing the number here. So unless this shutdown is much longer, then I think it will impact. But for now, I don't think it's going to impact the markets because we've gone through these shutdowns before. Do you have any suggestion of fixed income front view on the latest interest rate? I think fixed income, I'm going to leave it to Sean because he's our fixed income analyst. Okay. Do you have any suggestion on fixed income? Yeah, appreciate including use. I think for me, again, I'm not an FX expert, but I think US dollar should be the one that should hold since everyone has this higher for longer, and their growth is much better than Australia or even UK. So this is my own gut because FX is about the relative performance of the economy and also the interest rates. So it seems to be more favorable, at least near term, for the US. What are the best risks and rewards for investments right now? So we are actually very cautious now. That's why we only stick to very defensive names, and as you can detect, we are more into the relative performance rather than absolute. That means you can outperform the market, but it doesn't mean that you can generate returns. So for us, we still like the banks in a way, I guess. Like OCBC got 6% dividend yield, and we think this can support the share price. Of course, everyone worries that the earnings will come down if but if interest rates come down, then the 6% will, even though it might come off a little bit, it will still be attractive on a relative sense. And in this environment of higher for longer kind of interest rates, because we think at least for the next 3 to 4 months, I think the banks will still perform better, I think. But as you can see, we're very hesitant because when we think economic outlook is weak, there's not really many great stock ideas for us. Okay, I think I exhausted all my questions. Some of them were pretty bad answers. But anyway, can some of you take some of the questions? Yeah.
I'll
Yeah,
answer the. Oh, sorry. You
sorry. Thanks, Peggy. Yeah, I'll just step in a quick one. There's a question on Manulife, whether there are any new developments on that. The share price continues to fall. Yeah, so for that, there are no recent developments, but we believe that they are right now in advanced talks with their sponsors to come up with a plan to solve their issues. Yeah, so yeah, we do not have any updates, but we believe we'll get some material updates in the near future, especially during their maybe their third quarter results. Yeah, so no updates on that. What do you think of Keppel DC REIT? It seems very volatile and it's dividend growing. Yeah, so for Keppel DC REIT, they are having their dividend is about 4.5%. And then for their properties, half of it is tagged to CPI. But for the dividend potential for Keppel DC REIT to grow, in my opinion, is quite neutral or flattish. Yeah, mainly because of the high interest rates as well. Yeah, but for Keppel DC, any inorganic growth for them likely will be from the Genting Lane data center, KDC7 from their sponsor Keppel. Yeah, I think that's the only inorganic growth opportunity that I see might be worth for them. Yeah, so yeah, for Keppel DC right now, we actually have a neutral call at with a target price of 226. Yeah, CapitaLand Escort Trust and CapitaLand Ascendas REIT, TA and FA. Yeah, so TA will lead to Zin. Yeah, so for FA, first of all, CapitaLand Escort Trust, their share price has been weak ever since their private placement and rights issue. So the placement and rights issue was at 1.025 cents. So that's the rights issue. The placement was done slightly higher, but the markets obviously didn't take the placement and rights issue well, as right now it's trading at even below the placement and rights issue price. Yeah, but fundamentally we still like CapitaLand Escort Trust for the geographical diversification and as well as the rebound in hospitality since COVID. Right now, RevPARs across the board, in most of the countries are already above pre-COVID levels, and average daily room rates are also at all-time highs in many countries as well. And for CapitaLand Ascendas REIT, we do not cover CapitaLand Ascendas REIT, but they are benefiting from high rental reversions from a lot of the logistic assets. As we saw in the previous quarter, they saw double-digit rental reversions in a lot of their assets. But for CapitaLand Ascendas REIT, right now they are trading at about 5%, 5% dividend yield. Yeah. I'll leave the TA portion to Zain. Yeah, you mentioned prime REIT would be one which we consider for good gains. Is that that's more of a tactical but a strategy approach? Which one REIT will you think is best fit for gains instead of capital yield with a time frame of 1 to 2 years? Yeah, so in terms of capital and yield with a time frame of 1 to 2 years, it's hard to see, in my opinion, that any REIT will have a good capital appreciation potential with good returns in the near term and to grow their yield as well. But for me, I think I would put a CapitaLand Escort REIT there for the next 1-2 years, because they have a near term, like I believe they have a near term overhang of these new issued shares in the market for maybe a couple of months. And then after that, I believe the share price will recover as together with the hospitality recovery. And towards the second half, we expect the dividends, the DPU payment to increase year on year by a good percentage, as we know that the return recovery in travel all will help to boost their RevPAR numbers. Yeah, and we expect the dividend yield also to increase for CapitaLand Escort. Yeah, so I'll put that as one of the best fit or gains in terms of capital and yield. With so many REITs at PB less than 0.5, why don't the major shareholders privatize the REITs? Yeah, so for privatization, I guess you have to raise funds as well. But in this high interest rate environment, many of these major shareholders might not want to do so. Yes, so I don't really know why. So maybe upon Peggy, if you have a clear answer, you can step in for that. But yeah, for me, I don't see why they might want to privatize the REITs. Yeah, the market might not take it too well also, and they do not want to overpay for REITs also for the major shareholders. Yeah, I think that's all I can think about. Yeah, Escort divested 4 assets in France. Is the divestment viewed positive, negative? Is the gearing okay? Yeah, so the assets, the divested in France were divested at 63% book value. And yeah, so this divestment is viewed as positive, that it was done at, I believe, at an exit yield of about 4%. Yeah, so if you combine that with their proposed acquisition, so it will be about 1.8% DPU accretive on a pro forma basis. Yeah, so it's actually accretive for them. Yeah, and their gearing is okay. Yeah, the gearing right now for CapitaLand Escort Trust is at under 40%. Yep. Yeah, thanks. I think that's all for me. Yeah, thanks, Peggy. Hand over to you.
Okay, thanks, Darren. Okay, maybe I answer the question on the follow-up on the privatization question like after Darren's explanation. Okay, if for Darren is right. In a rising interest rate environment, it makes it very costly to carry out privatization. So even if they're not the REITs, but the other stocks in the Singapore market, the privatization momentum might slow because of the higher interest rate. The other thing is that REIT gearing is calculated based on the total debt divided by total assets. But if we use the normal way of calculating a net gearing for a company, most of these gearing will not be 40%. It will be more like above 60, 70%. So the gearing levels for REITs, public REITs are actually go by the traditional way of calculating for a company could be high. The other thing is that staying listed has some advantage. Public listed REITs, you enjoy a tax-free distribution, and there are other advantages. Of course, your leverage ratio is capped at 50% mandated by MAS. Whilst private, you might not have this cap. But still, it's a very costly exercise for any major shareholders to take REITs private. But not having said that, it's not impossible though. But you need really very strong sponsors with very big financial muscles to come in to do this. So we don't think it will happen for Singapore REITs who have just in the last few years merged to become much bigger. So it's even more difficult to privatize a very large REIT. Okay, that's my 2 cents worth for that answer question. Move on to the CSE question earlier. CSE, my personal opinion is that I'm not comfortable with the cash flow. Although revenue has improved by 33% in first half, net profit has grown by more than 100%. But the cash flow, in terms of operating cash flow and free cash flows, are still negative. It's been negative for about 18 months now. So they have been doing more work, but they're not been collecting money as fast. So the gearing has also gone up to 0.5 times. And in a higher rising interest rate environment, higher gearing is not, it will weigh on the profitability going forward. So that is our that's the reason for our we have our reservation on CSE Global. But for the full year of this year, of course the profit will be the growth will be very, very strong compared to last year, because second half of last year they actually incurred a net loss of negative 1 million. So first half they made 11 million in first half 23. So that again already make it a very strong a year of very strong growth in FY23. The higher oil price will benefit them in terms of, like, if it's sustained, will encourage the more shale oil activities in the Permian Basin, and they continue to be occupied with work like the EV charging, installing the EV charging stations, as well as more work for data and connectivity as the population, US population, see more migration into the cities and into the region which they have secure work. So yeah, that's our views on CSE Global. There's a question on views on Delphi Capital Corp, Seastream, SCI Venture. I assume they want some fundamental views here. So I'll talk about Capital Corp, Seastream, and SCI. The higher energy prices led by higher oil price will benefit Capital Corp and SCI in their power generation income. But higher interest rates will drag down the plans for Capital Corp to divest some of their assets. Capital Corp has always has in mind the assets restructuring, asset monetization plan to divest some of the assets either to other listed REITs or to the funds that they have raised together with the party. So this weakness in the property sector in China will affect both Keppel and Sembcorp, and the higher interest rates will also affect their balance sheet and the ability of them to divest their assets, because the buyers will face more inertia in terms of higher cost of funding, highest cost of fund. So the near term higher interest rates will impact all these companies, including Seastream, who has also a very high gearing, and Sembcorp whose gearing is also nearly on time. So that's our view for this sector. But given the higher interest rate environment, like Paul mentioned, we look at more at relative performance. Our stock picks are more based on relative performance rather than absolute. So it's when in an environment like this, with uncertainty of whether the higher oil price will lead to a recession going down further down the road, then the tendency is to skew towards the big cap stocks, and therefore meeting Keppel and Sembcorp will remain in the portfolio of most of the institutional investors. Yeah. Thanks. This is my view on Keppel and C3 and Sembcorp. I pass on to the rest. Thank you.
Yeah, hand it over to Zain. I think we'll try and run through the rest after Zain. Thanks.
Okay, thanks everyone. I'll start with the TA portion. Okay, so first one I start with Mapletree Peninsula Commercial Trust. So recently there's some downside momentum. We actually broke below the support of this 146, 147. So with that, I think downtrend is still continuing on. Could potentially find the next support closer to about 140 level, which was like a previous swing low back April 2020 over there as a next support. Then next one is CICT. Okay, for CICT, it looks like still some consolidation likely to take place. So the main thing to take note is the main trend will be a consolidation in this triangle pattern over here. Yeah, some weakness recently pulling back. So I think first level of support could possibly be around 184 over here. Then the recent swing were at 181 as well. The next one is Agricultural Bank of China. So for this, looks like the upwards momentum is still okay. Broke out from this channel over here after and the consolidation we took off last week. Currently at some resistance levels around the 280, 290 level. So could see a little bit of a consolidation take place over here. Yeah, then near-term resistance upwards will be this $3 retest over here. Okay, then I'll move on to the local banks. So first one is DBS. So DBS actually price actually came back down after retesting the swing high around here, around the 34, around the $34 mark over there. Then currently finding support around this trend line as well as the recent range lows, which was around 31, 33, 10 over there. So if this level can hold, could potentially see a bit of a consolidation take place with near-term resistance close to about one level at 33.60, the next level will be at 33.90 over there. The next one, OCBC. OCBC also retested the range lows 1240, currently rebounding. So some resistance could be around 1270 over here, and followed by around 1290 this level again. And as for UOB is a bit weaker, broke down this trend line support. Yeah, so some support around here 2890 if it's able to hold these lows. Resistance could be at around 2860 over here to about 2870s. And next one, what's the TA for CocoLand? Okay, for CocoLand looks like nothing too much. Short term wise, I think could be still consolidating in a range over here as it's been since May. resistance is still quite strong over here, 157 level. There could be resistance also 158 if there's this trend line over here. So I expect some strong resistance to remain over here. But support is still holding currently at this horizontal around 150s. Yeah. So potentially could see continued range consolidation near term. Okay, the next question are TA on STI, which supposedly show a head and shoulders. Do you think it's moving out of this formation slightly downtrend? Okay, yeah. For STI, there's some head and shoulders potential head and shoulders going on. Recently, yeah, we also came back off from the 3,280 to 3,290 level, which was this support actually broke down from. And then also some very signs would be that we couldn't maintain this retest of 3,230, 3,240 here as well as this trend line support. So currently there could be some bit of a weakness for STI. Maybe some short-term rebound here, we see some resistance. Yeah, then whether we will see a breakdown, I think for now the head and shoulders breakdown probably will not take place so soon, I guess. But since that likely some bounce or there's still some support near to about 3,100 over here. So in terms of the weekly chart wise, still need some time to break down over here for some more bearish downside, I would think. Yeah. But there is some potential signs of weakness when you look at the longer time frame where lower highs have been formed over here, and then the bounces have been getting weaker, the lower highs. Next one is Delphi. Okay, Delphi range consolidation, but maybe one positive thing is that the support is still the support 118 is still holding, but recently you look at the MACD wise, has been higher low being formed. So potentially let's see whether price is able to trade higher, form a higher low and trade higher. Currently we tested the swing high 128, still finding some resistance over here for now. So probably would do a little bit of maybe a sideways trading still for now. Okay, next one, Food Empire. Food Empire, some positive signs would be higher highs and higher lows have been formed recently. So as long as the recent breakout of this 107 level is still supported along with this trend, I think the price could still continue to hit higher in the near term. And the next resistance levels could be at about 111 to about 112 over here, where it was a previous breakdown that took place over here. And then over here we had a retest over here. Okay, the next one is FLCT. Okay, FLCT recently broke down this 115 support. Next level of support could potentially be at 109 over here. There was a range consolidation in December last year. Then the next support downwards would be 106. So these are some levels to think. Yeah. The downtrend, yeah, is still continuing on. Okay, the next one is Keppel REIT. So for Keppel REIT, looks like still some weakness near term breakdown this channel did a retest and subsequently pull back. So I think could maybe see some consolidation still possible. Then for Mapletree Logistics Trust, I think recently we tested the confluence of this consolidation wedge resistance as well as this strong horizontal resistance at 172, still facing resistance. So likely we should be continuing on to see some sort of consolidation take place in this wedge over here. Some near-term supports could be around from 163 to maybe 165 over. And then next up for land lease. Okay, land lease rebounded after testing the this trend line over here around 54 cents. And then price currently I think just sideways over here for now. Maybe that could continue for now. Near-term resistance could be from these 57 cents to about 58 cents level here. 58 cents being the previous support level back in 2021. Okay, next up, Hong Kong land. Yeah, nothing too much. It's still kept in the range for quite a long time, really, about 2 months. Yeah. So I think to take note will be whether there's a potential breakdown. Yeah, of this support, potentially see maybe price hit to test 330 next as a next support. And then as for UOL also currently just range trading over here for now. So maybe that could continue the support at 630 is still able to hold. And then for city developments, also nothing too much for now. Another test, still like range trading for now. Another test of support near 660. So if it's able to hold it, could potentially see a bit of a bounce. But looking at the longer term wise, I think share price showing some signs of weakness still over here. Lower highs created over. Yeah, so if this level 660 doesn't hold, likely we could see maybe price go down to 640s over here. Okay, next up is Keppel Corp. So for Keppel Corp, I think currently it's still in a bit of a consolidation phase over here. Near-term supports could come from these swing lows, these recent swing lows around the 660s over here, as well as this trend line support as well. So yeah, over here there should be some support coming in. And then resistance should be this level still around the $7 mark over here. Okay, then for SAM Industries, currently is consolidating in the range over here. So likely that will continue still if the support and resistance still holds, which is around 505, as well as resistance around close to 523 over here. But he's still trading inside this potential downtrend channel over here for now. So yeah, to break out this trend, we need to see a breakout of this level. Then for trend continuation would be a breakdown of this support. Yeah, then the next support could be at around the previous range breakout level, which was around 480s, 490. Okay. Okay, for next one, Escort. Okay, for Escort, I think currently bit of a range consolidation perhaps. Yeah, nothing too much. It's just sideways trading for many days already. So likely that potentially continue. Okay, the next one, Keppel DC. Keppel DC might be consolidating for now. Recently we tested this trend line support around the 210 level rebounded, and yeah, we tested this broken down support 216. So maybe that this consolidation phase will still continue until yeah, for a while before we see a trend continuation upwards or a reversal downwards. Okay, then next one for ComfortDelGro, price has been just slowly inching upwards and just sideways for now. With some resistance at around 130, which was the previous swing high. And next resistance level would be at 133, 134 over here. Yeah, but I think from the MACD and RSI wise, some divergence taking place over here. So some momentum remains quite weak over here for CDG. Okay, then for Singtel, we just a normal pullback after hitting the 248 level over here resistance. I think probably we'll do a bit of a range this week. As it's been testing some this higher resistance break of around 240 over here. Yeah, so maybe just sideways trading for the near term. Okay, next up, Tencent Holdings. Okay, so Tencent, recently we tested this swing low around the 307 level. There was a rebound on Friday. Today seeing a little bit of a pullback. Yeah, so I think for now the downtrend is still continuing on, but if this level is able to hold as support, maybe you should see some sideways trading. Immediate resistance is close to 315, this breakdown level over here. Okay, then for 2801, BlackRock Asset Management North Asia ETF. And so for this, I think too much. It's been still kept in the range over here recently. Just another retest of the support around the $18.40 mark. Yeah, so maybe we just going to see a bit of a range trade. Yeah, but one thing to think will be this stretch, the lower highs being formed over here. And as for 3067, yeah, another iShares Asia Hang Seng Tech ETF. Okay, so this one also another test of the support recently over here. Then currently doing a bit of rebound, but I think still the downtrend is still quite strong over here. See lower highs as well as lower lows being formed. So maybe just a slight rebound, maybe test these levels and maybe just do a bit of sideways trading. And next up, Disney as well as PayPal. For Disney, recently we tested prior supported resistance at $85, and we've seen some rejection. So I think for now, given the downtrend in stock, potentially you could see another retest of the swing low support close to $80 about here. And let's see whether it managed to form a range first. Next one, PayPal. Okay, PayPal met some resistance this week. The prior retest of this prior support over here, the resistance. And some bearish signs was that price was unable to hold some recent supports like this swing low at $60 over here and then plus continue breakthrough. So potentially, let's see whether this swing low is able to hold at 57. If not, likely the downtrend is still going to continue after a bit of a range formation over here. So potentially after 57, the next support could be closer to 55. Looking at historical levels like back in 2017, this prior resistance level. Okay, please advise on the TA of CapitaLand China, as well as Purchase potential recovery. Okay, so for CapitaLand China, yeah, the downtrend is still continuing on recently. Potentially a retest of this swing lows at 87.5 cents. So let's see whether price is able to find support over there in the near term to do some sort of bounce. Okay, then CLAS as well as CLAR. Okay, so for Ascenders, I think the uptrend channel is still holding over here. Recently you saw a retest of the swing low 274 over here, confirming the channel over here. So yeah, it's still holding. So I'm expecting perhaps another test of this 284, 285 resistance level sometime soon again, and see how it goes. Okay, then for SIA, the downtrend is still continuing on. Recently tested a support level at 660, which was a prior resistance level. Yeah, so 660 was a previous swing high. The next support level will likely come closer to 630 over here. Prior resistance still was back in 2019. Then looking at the recent levels, this was back in May this year. There's a breakout above this level, so this would be a better support. Okay. My views on Tesla, AMD, as well as Pepsi. Okay, so for Tesla, some downside. I think some downside for now. Few things being after a test of the resistance around here, around the 270s level, which was this downtrend resistance line over here. Then price was unable to hold this short-term uptrend channel over here. And then another sign was that retest of this prior resistance at 256 to 67 was unable to hold on Friday. We had a bearish close. Likely, I think price is going to come down to retest some of these lower levels in the near term, which is going to be closer to our 240s over here, where we saw a previous resistance as well as support. Now let me see if the price is able to hold at this level. Okay, then for AMD, there was a breakdown. After the breakdown of this main uptrend channel over here, price has broken down the recent support as well as 99. Went on to retest this what is trendline support 96. So we have to see whether price is able to hold for some sort of rebound, but still expect some near-term resistance to be quite strong, close to 99 to 100 over here. Then potentially, if price continues to drop, the next support level could be quite near, maybe 90, 94 over here. But the swing low as well as the previous range support level as well. Even for PepsiCo, I think is a range building for now. So we tested this level 174. Let's see if price is able to hold for some potential rebound to continue on this range for now. Yeah. If not, if there's a breakdown, then the next support level will potentially be at 371 next. Okay, next one, 3032 ASI Management Tech ETF. So for this, another test of the recent support, a few supports over here between 3.8 to about 3.88. So we see whether it's able to hold. If it doesn't, then likely we go on to the next horizontal level, could be around 3.73 over here. Okay, then other Hong Kong counters would be like Alibaba. Alibaba, I think for now, likely to continue the downtrend. Is after a breakdown of this channel over here, prior support term resistance still. Yeah, so if it's unable to climb back above this $7 level to test like $89 or $90, then it's gonna likely to come down to next support, which is closer to 81 over here. Okay, then as for the next one is Ping An Insurance. Yeah, so Ping An Insurance last week just range trading this week. Okay, so then we found some support still holding on at 45. Yeah, so we need to see the support continue to hold at this level for some potential rebound to try and test the near-term range resistance closer to 48 to 49. If not, if this level breaks, then likely to see further downside towards 44 over here. The next one is iFast. Okay, iFast, I think potentially some weakness in the share price potential building. So there was a false breakout of this 580s level over here. And then likely it's still consolidating on in the wedge. But in terms of the momentum indicators, you can see there's negative divergence forming. So if there's a breakdown, likely we'll see price coming back down to supports like 550s over here as well as 540s. Okay, next one, Digital Core REIT. Okay. Okay, I'm not sure why there's such a long week, but last Friday. But for now, there looks to be some signs of potential reversal, since that in this uptrend stretch, it's broken this prior resistance level of 56 cents, and price actually technically there was a low, they were broken the series of higher lows over here. So yeah, could see maybe some range consolidation or towards the downside for now. Okay, then next one, CapitaLand Investment. CapitaLand Invest, I think it's still continuing on at its range over here. Yeah, so likely to still find resistance along the trend line over here. So that will be around 320, like to about 320, likely to find some resistance over there. So support will still be around 302 to 308. Yeah, so I think that potentially will still continue. And then for venture fine after the rebound, like the support 1270 just consolidating a range. So potentially that could still continue unless there's a breakout of this $13.30. Then potentially could see further upside. If not, likely it's just some sideways trading for now. Okay, then for SGX, I think yeah, I think the price just mostly trading was recently there was a test of the resistance and subsequently came back down under. So let's see whether this whether it's able to hold this 970 previous resistance as support. If it does, then could potentially see consolidating in a higher range over here between this support and close to $10. Okay, then for UMS, I think potentially consolidating in this ascending triangle over here. So you see what's the next move, upwards or downwards. After 120, the resistance line to be at 130 over here. Then if there's a breakdown, the near-term support could be at 120 over here. Okay, then next one is Franken. Okay, Franken. The positive signs is that the breakout of this downtrend resistance line over here looks like still holding on end of last week. So if it's able to, this support is able to hold at 104, 105, right? Then potentially could see maybe a bounce upwards soon. Maybe just consolidate for now. Okay, then for First Resources, okay, another test of the resistance at 150, 157. Yeah, but for now, it likely to just build a range for now. Okay, after 157, if there's a breakout, the next resistance could likely come in closer to 162 to about 166, which was these prior resistance levels back. This was back in 2021 as well as last year. JD.com, I think like weakness for now. This is a new low being created if I'm not wrong. Then breakdown of this recent low. So yeah, downside momentum is likely to still continuing on for now. Unless there's like a breakout this resistance line, then potentially could retest this level at close to 31, close to $32. If not, like we could see further downside. Okay, then for JD Logistics, yeah, similar as well for lower low in form. So this lower low. Okay, but in terms of the MACD RSI, there's a higher low in form. So we see whether there's potential trend reversal taking place. You need to see price hold in the range first, hopefully, and then as well as break up this crucial resistance at around 10 over here. Okay, then for I2, okay, I also recently broke down the support, which was at around 135. Currently, there's some bounce taking place. Maybe some potential retest taking place, but I need to still face resistance. Okay, then next one, Suntec. Yeah, Suntec rate likely still holding on for now. Yeah, still some resistance close at the swing high 124, which was the breakdown over here. Next one, China Aviation. Okay, for China Aviation, it looks like there was a retest of the prior this support breakdown as well as this swing high at 92 cents. So and prices subsequently came down. So they actually just could see a bit of a wave over here if the support at this swing low 87 cents holds on. Okay, then for Grand Venture, Grand Venture looks like potential continuation of the recent pullback. Broke down of this 58 cents level, the support, which was a prior resistance, and in terms of the momentum indicators, you still see some bearish momentum. So potentially it could continue to trend downwards. Some key supports next could potentially be at 54 cents to about 55 cents, this zone over here. And then for Adobe, bearish development last week was the breakdown of this trend line, as well as price has been trading downwards recently, breaking some supports along the way. So with that, likely we could see if price continues the downside, likely will be a retest of these lows closer to 500 over here, or even this range breakout previously was like 490. Okay, then for metal, still looks like still some weakness going on. Retest of the price support and resistance at 310. So price came down and just sideways along at this prior short-term resistance over here. Yeah. And I tried to rebound, but there was a shooting star Friday as well. So yeah, still some weakness going on. Maybe we should see some sideways trading if the support at 290 is still holding on. If not, deeper pullback maybe bring price closer to about 287 level. Okay, next up will be Wilmar. Okay, Wilmar for now, I think nothing too much. It's just holding on in range for now. Yeah. So likely they will still continue resistance at around 380 while support is close to about 366. Okay, next one 3191 Miri Assets Global Investments. It's China Semiconductor ETF. Yeah, recently looks like another test of the support recently, close to 35. So, and MECR is high, we see a higher low income. So we see whether price is able to hold and whether there's a positive possible for price to sort of bounce near term resistance at 37 versus 39. Okay, then for 981 semiconductor manufacturing, it looks like there was a breakout and there was a retest that took place recently at this close to 1890s level. Okay, so whether you see whether whether there will be a positive crossover in terms of MEC for momentum to continue upwards, yeah, to do a bounce. Yeah, price needs to overcome this level at 1980 for a chance to retest $21 again over here to sort of continue the bounce up, the momentum. Okay, I'll just take two more on Salesforce as well as Google. Okay, so for Salesforce, yeah, recent bearish momentum pulling back to, I think it's going to retest this support zone again. So one support level is at 205 over here. The next one will be this swing low at 200. Then as for Google, okay, Google some bearish development as well. Breakdown of this trend line, as well as this support 133, 134, this horizontal support. So potentially, if price is unable to recover back, some potential further downside to try and retest the next support zone, which is around 126, 127 over here. Okay, I think that's all for me. I'll hand back the time to my colleagues if they have any more questions to answer. Thanks.
Thanks. Let me just try to wrap up as much as we can. With the sudden spike in Berkshire stock price related to price of oil, sorry, we don't cover, so we're not particularly sure. Because we don't have like a sum of parts of Berkshire, so we don't really even know which are the largest components of Berkshire's holdings. Sean, you want to answer this fixed income thing?
Yeah, sure. So, I mean, give me a moment. Let me take a look at the questions. Yep. So, do you have suggestion on fixed income front in the view of the latest interest rate view? So, I mean, in terms of fixed income, with the latest interest rate view, yes, it's true that the prices for past bond issuance might face some slight headwinds due to the latest hawkish interest rate view, as prices of bonds and yields are inversely related. But this should normalize once we start to see more certainty when inflation data pointers are easing. And I mean, additionally, I think this is not all doom and gloom for fixed income, although I know Paul did show a chart that bonds are at its all-time low. But I mean, currently in this high interest rate environment, this also presents opportunities for investors to look into new issuance and to lock in these interest rates that could be appealing to them. And also, I mean, this also allows investors to capture the upside price potentials when the interest rate starts to taper off in 2024. I mean, because current new bond issuance are issued at a slightly higher coupon rates as compared to a similar bond that has the same tenor and a risk level back when it was probably issued during a COVID period. So as I've mentioned earlier, the yield for 6 months T-bill is currently at 3.73. So for investors who are interested in looking into fixed income, this is the bare minimum that you should be looking for. And I believe just 2 weeks ago, there was a HSBC issuance of 5.3% that comes with, I think, 10.5 years to maturity. So the prices for these bonds, although have come down by 0.1, currently it's still trading at a level above par at an indicative pricing of 100.87, which gives off a yield of slightly around 5.11%. So I mean, although yield may look attractive for this bond, but do note that this is a tier 2 bond, which is also subjected to the write-down feature similar to AT1 bonds, just that these bonds are ranked one rank higher when it comes to repayment, when the banks are facing liquidity issues. Yeah, so I hope that answers your question on the fixed income portion. Thank you.
I guess for me, I would just add is that I would rather buy the front end or the shorter term bonds to take advantage of the yield inversion. Because the unknown right now is what is the so-called real yield that you have? Because if you look at the longer term, this very long term, doesn't mean you hit there, but assuming the Federal Reserve hit their 2% PCE, which we are not sure, 2% inflation rate, then you add in 1% for the normally between the Fed and the 10-year, I mean, there's a 1% premium because you need a premium because right now it's inversion. So that gets you the 10-year yield of 3% for the US. Then if you add in the real yield, although the last few years has been negative, that means the inflation rate minus interest. So you were probably looking at, that's usually about 1.5. So you're looking at a fair value for bonds at maybe 4.5. So what it means is also we are just not very sure how much the 10-year bond yield can come down because people might expect inflation to be elevated, and also if the US government continues to continue to issue so much debt. So so at that, if that happens, then if you look at the long-term numbers, 2 + 1 + 1.5, right? Then bond yields are more or less trading at fair value right now. The 10-year, I'm talking about the 10-year bond yields. So maybe it's better to get the front end, the 2-year bond yields and so forth. I mean, just as my own general view of bonds, although I'm not the expert, but anyway. Let's move on to the next one. Okay. The platform, both in APP and laptops, are not accessible in China. Hope you are aware and doing something to remediate. Yeah, I need to check this. I will ask this from our global market desk. I'm not particularly sure. But thanks for the question. Let me send them a email or WhatsApp. I noticed that Japanese ETS marked in Singapore banks are reflecting 3-year very positive. Will they sorry, this I'm not very particularly sure. ETS mark in Singapore banks. So I'm not familiar with what you're actually asking. Sorry for that. Yeah. What's your view local semiconductor chain when Huawei started to produce new chips using? I'm not really sure how they get the Chinese suppliers because the latest Huawei chip is 7 nanometer. So I'm not sure where you get the equipment. So, but if they actually have their own semicon, then none of the local semiconductors say they supply equipment to a semicon. I really no idea how you get 7 nanometer without using US semiconductor equipment, especially the lithograph or the ASML machine. So I'm not sure. But if it's an ASML, then if there's I'm not sure if there's leakage, but if there's ASML, then this will be Franken will benefit from it. Any bank stocks in China to buy? Yes. Sorry, we don't cover China, so any tech stocks? Yes. So apologies, you have to ask our Hong Kong research. We don't cover. We probably give you wrong answer anyway. Please comment on the reasons Vicom share price dropping. Oh, okay. I had a quick look at it. Normally don't ask comfort on Vicom because it's quite small, but I think Vicom number one cut their dividends by I think annualized 1 cent. They cut 0.5. So the dividends dropped from 6.6 to 5.5. So that in the most recent interim results, they also cut their dividend payout from 90% to 70%. mainly because they're going to build one new facility in Jalan Papan. The reason they mentioned because of they paid too much dividends, I think in a nutshell, because their cash dropped from 100 million to 50 million. And the second thing is because they've been paying cash more than their free cash flow. So although they generate like 30 million of operating cash flow, they pay out 30 million of dividends, but they still have to, they are not covered for capex of about 10 million a year. So that's why I guess it's another lesson if the company pays more than their free cash flow. Okay, any insight in the sudden jump criteria? Sorry, I don't follow. Sorry, so don't have any. Okay, that okay? So thanks. I think we answered most of the questions. I'm not sure, Darren, you taking anything? Yeah.
Can you hear me? I'll show my
Yes,
comment. My
yes.
phone.
Yes, yes.
Yeah,
go ahead.
I cause I can't see a chat, but I think the question was please go through the top 5 picks again. So instead of going through the top 5 picks, let me just say a good run through the course that we have for our in-house course. So we have a buy or accumulate call for Accessory, Land Lease, Prime, Escort, FCT. Yeah, so yeah, you can say that that's our top 5 picks. And yeah, Suntec REIT as well. Yeah, so these are the REITs. Yeah, so I'll hand back to you. Thanks.
Okay. With that, thanks everyone for your time and for especially all the questions. And no, do join our community if you've got any questions, and also you can read some of our comments there. With that, I'll thank everyone and have a good week ahead and take care. Thank you, everyone.